Assalamu alaikum everyone, hope you're doing well. So in this class I'll explain you one complete paper, and this is March 2024 exam series and variant is 3.2, and this video is for A2 Economics paper 3. Okay, so let's move on to the questions, and the scheme is you can stop the video, read the question carefully, and once you have decided the answer, then again play the video and listen to the logic. Question number 1 is I'll also make one video explaining the important questions or important topics that may be tested in upcoming exam that is going to happen in a few days, day after tomorrow rather. So I'll post that video tomorrow early morning. Question number 1 is a person buys 2 pairs of socks. What does the purchase of the second pair of socks lead to, right? So it is really important concept of economics regarding consumer behavior, and that is marginal utility, law of diminishing marginal utility. And law of diminishing marginal utility states that when we keep consuming the same product repeatedly, then marginal utility of every additional unit goes on to decrease. So for this question, option B is the correct answer. That says a decrease in marginal utility. So again, keep in mind, we generally take the example of water. When we drink first glass of water, it gives more satisfaction. The second glass of water gives less marginal utility, and so on so forth. So this law can be applied to any product. Like here we have like socks. If you keep purchasing the socks, same type of pair of socks, then every additional pair of socks will give you lesser marginal utility. So option B is the correct answer. You can read all other options, and if you're confused with any of them, then you may write in the comment and I'll get back to you as early as possible. Question number 2 says, what does an indifference curve show? Indifference curve is basically the graph that shows different combinations of two products that provide the same level of satisfaction. So you must know the basic knowledge or basic definition of the indifference curve. In economics, curve mean any type of graph, and indifference mean it makes no difference for the consumer because he gets the same level of satisfaction. So this is the basic knowledge question. So option B is correct answer. The different combinations of two products that give a consumer equal utility. Right, so all other options are incorrect, so you can read all of them. If any one of the option is confusing you, then you can write in the comment and I'll explain you later on. Question number 3 says the table shows, I'm not explaining all of the options because it takes a lot of time and video becomes too large to export and then post it on YouTube. So that's why I'm trying to make the shortest video possible, and if you are confused with any other option, please write in the comments. Question number 3 says the table shows the total amount consumers are willing to pay for different quantities of good X and total external benefits, right, that arise from the consumption of X. X is a product, name of the product. So these are different quantities in thousands. 000 mean thousands. So 1000, 2000, 3000, 4000 and 5000. And consumers' willingness to pay is also in $1,000. So it is like private benefit. Consumer willingness to pay shows private benefits. And this is external benefit, right? So examiner says, what is the value of marginal social benefits when 5000 units are consumed? So this is 5000 units, right? So for marginal social benefits, you will have to show like basically find the change in social benefits from 4 to 5000. So first of all, you need social benefits, and social benefits are calculated as like private benefits plus external benefits. So these are external benefits, these are private benefits, and these are external benefits. So we need not to calculate all the values, just move on to these two values because we need to find the change. Okay, so if we like calculate social benefit on 4000 quantity, then it will be like 280,000 plus 68,000 it makes like 348,000, and 300 plus 80, because we will put these values into this formula, that is private benefit plus external benefit gives us social benefits. So 300 plus 80 is equal to 380. Okay, so now you have to find out the change, right? When we move from 4,000 to 5,000, what is the change in social benefits, right? Change means difference. Difference can be calculated as 380 minus 348, and this is equal to 32, and all figures are in thousand, so we will say 32,000, right? So option B will be the correct answer. Okay, so now moving to the next question, and this question says the statements and the table provide information about a production function. The production function represents the amount of one, like you have to pick value from this. So the basic definition of production function is production function represents the amount of output, so we will pick option C or D, obtained from each combination of inputs. So again option C and D can be the correct, so you can cross the first two values, and can be used to give information about returns to scale, not supernormal profit. So option C is the correct answer. Production function is relevant to the relationship between input and output that lead to a certain amount of return in the form of output. And returns to scale like mean increasing returns to scale, decreasing returns to scale, and constant returns to scale. Increasing returns to scale happens when increase in input leads to more than proportionate increase in output, and decreasing returns is opposite to that, and constant returns is when increase in input leads to the same proportion of increase in output. Option C is correct answer. And now moving to question number 5. Two firms selling the same type of good, selling the same type of product, find it more efficient to merge, right? Merger is basically when two or more businesses combine their assets and liabilities to form a big business. Which combination describes how the merged firm's average cost of production and demand curve are expected to change? When firms merge, they become large and they can produce at large scale. When they produce at large scale, they can achieve economies of scale, and economies of scale will lead to fall in average cost of production. So option A and B can be the correct answer, so we can cross C and D, right? So when business becomes large, it can produce at large scale, and large scale production leads to fall in average cost due to economies of scale. Then what happens to the demand curve when firms become merged and become large? Then their demand will become inelastic, because now competition will reduce and there are less substitutes, because now there is only one firm, and it may form a monopoly position, and in case of monopoly position, demand curve becomes relatively inelastic. It means change in price will not affect the demand a lot, right? So option B is the correct answer. Inelastic demand becomes inelastic because now people don't have other options, so they will have to purchase the same product even if its price is high. Moving to question number 6, the diagram shows the cost and revenue curves of a firm operating in imperfect market, right? So these are different costs. You can stop the video and look into the question carefully. The firm is currently producing at the profit maximizing level of output. It means it would be at this point, W. So OW will be the initial output. Profit maximization, condition of profit maximization is marginal cost is equal to marginal revenue. So this is marginal revenue line, this line is marginal revenue, and this is marginal cost. So marginal cost and marginal revenue meet each other at this point, so this will be the OW will be the profit maximizing output. Okay, so now moving to the next part, it wishes to produce at the sales maximizing level of output. Sales maximization takes place where average cost is equal to average revenue. So this is average cost, this is average revenue, and they intersect each other at this point where output is Z. So initially profit maximizing output was OW, and now sales volume maximizing output is OZ. So option C will be the correct answer, OW to OZ. Okay, so the next question is, examiner may also ask about sales revenue maximization. If it does, then sales revenue maximization happens when marginal revenue is 0, like at point X. So in the next question, examiner may ask such questions, so I thought I should tell you the condition for sales revenue maximization as well. So question number 7 is, in which market structure is dynamic efficiency least likely to occur? I mean, dynamic efficiency happens due to the research and development, and when production takes place at large scale, firm affords to buy better machinery, technology and tools, and it becomes dynamically efficient. So perfectly competitive market structure is least likely to be dynamically efficient, because in perfectly competitive market, firms are very small in size, and they don't afford to buy efficient technology, machinery and tools, and they cannot undertake research and development. So perfect competition is a type of market structure where there are a lot of sellers selling similar type of goods, homogeneous products, and they are very small in size. So small size firms are dynamically inefficient generally. Okay, so other options, if any one of that is confusing you, then you may write in the comment. Question number 8 says, which type of employment contract is most likely to overcome principal agent problem? Principal agent problem is the conflict between owner of the business and employee of the business. Principal is owner of the business and agent is employee of the business. So principal agent problems basically occur when both have different objectives, right? Generally workers want to earn high salaries and more job security, while the principals, that are the owners of the business, they basically want to pay lesser wages for more working hours. So both of them have like different objectives, so that's why it causes conflict between them. So now principal agent problem, if we want to overcome principal agent problem, then what should we do? Stop the video, read all the options, and then listen to the logic that I'm explaining for option B, that is the correct answer. Linking workers' pay with profit of the firm to motivate them to raise the profitability of the firm. Right, this will not create problem or conflict between principal agent, because both have the same incentive now, right? Since workers will get more pay and salaries if business earns more profit, it means now workers also want to increase profit of the business because they have the interest in it. All other options are not basically satisfying the condition of this question, so you can read all of them, and if any one of them is confusing you, then write in the comment please. Again, I'm only explaining the right option because it will save time, it will make the video shorter as possible. Question number 9 says, company R manufactures steel, company S produces chips, and chips are produced with steel definitely. So these two industries are connected to each other. Company T operates in oil tankers, company V operates in cruise liner. Which statement is correct? If R takes over S, mean steel manufacturer takes over chips maker, या chips producer. This is an example of forward vertical integration. So this is the correct answer because steel is used as a raw material for making chips. So we are moving to the next level, next stage of production. And when we move to the forward stage of production, that is called forward vertical integration, right? If we move back, that would be backward vertical integration. If two firms merge with each other that have no connection to each other, that is conglomerate or diversification. And when two firms merge with each other that are at the same stage of production and they are in the same industry, that is called horizontal integration. So I have told you all the definitions of all other concepts given in this question, and option A is the correct answer. Hope you understand that. Question number 10 says there are two firms in an industry. Firm X faces a choice. It can either act independently or work with its rival. If it acts independently, its profit could be $900 a week, but it could be only $400 a week depending on what its rival does. Okay, so if it works with its rival, the joint profit of the total two firms together would be $1,400 and $700 each, and it has no knowledge of what other rival's policy will be. So this is kind of like the theory that is like prisoner's dilemma and or two-player payoff matrix as well. So option D will be the correct answer for this question, because in this scenarios when two firms are making like policies and they are not aware of and they don't have knowledge of what others are doing, and they take the decisions accordingly, then it's kind of called prisoner's dilemma. It's the basic requirement of basic definition of prisoner's dilemma. Why other options are incorrect? Other options are like contestable market. It is not contestable market because like firms like are the rival firms, and they are basically competing against each other, and they may be competing on prices. In contestable market, that is perfectly competitive market, prices remain the same and there is no need for contesting with each other on the basis of prices, because every seller charges the same price. And kink demand curve happens whenever there is price war and there is no like kind of thing that is depicting that it is price war happening here. Principal agent problem is when principal is owner of the business, agent is worker. So there is no conflict between owner and the worker in this given scenario. So it's the scenario of prisoner's dilemma, and sometimes we call it like two-player payoff matrix as well. And question number 11 says a government wishes to use market forces to remove negative externalities in consumption of a good, right? So government wants, the objective is removal of negative externalities caused by consumption. Which policy is likely to be the most effective, right? It means all options can be correct, but one option is the most appropriate answer. And if now we like move to the correct option, again stop the video, you can read all the options and try to figure out the correct answer, and then listen to the logic that I'm explaining for the correct answer only. And the correct answer is C. It should impose an indirect tax on consumers to reduce consumption to the socially efficient level, right? So like negative externalities are caused when demerit goods are consumed by the consumers. So if government imposes indirect tax, then demerit goods will get expensive, and as a result less people will purchase them, and economy will move to the socially efficient level of output, and negative externalities will be removed. Moving to question number 12, a government decides to replace a private company with its own company to collect household waste, and why could such action be justified? Okay, so initially it was a private company. Government decided to replace private company with its own company to collect. Like it was initially private company, now it becomes a public company or government company, right? So why could such action be justified, right? So question again, stop the question and read it carefully. Option D is the correct answer for this question. Private companies might put profit before customers' needs, right? So since private firms focus on their own profits, therefore government will like try to replace the private company into a public company or into a government company. Okay, so if like private companies are there to like collect the waste, then they will overcharge and people may start avoiding using the services of private companies. So as a result, it will increase pollution. So government wants to like take over such businesses and produce service itself. So this is why in most of the countries there are like government sector garbage disposal like type of companies. Okay, so question number 13 is what is a failure of the government microeconomic intervention, right? Question is quite tricky, but statement is quite tricky, but question is really simple. Failure of the government means when government interferes to achieve a certain objective, but actually what happens is it is unable to achieve that objective, right? So in this question, option D is again correct. Tariffs are imposed on imported goods which cause the Gini coefficient to increase. Gini coefficient is a measure of inequality, right? So what government tries to do is government wants to reduce inequalities, but if it uses this policy, that is the tariff is kind of indirect tax, and indirect taxes are the taxes that have more burden on the rich on the poor class and less burden on the rich class. So if government is trying to reduce Gini coefficient or reduce disparities or inequalities between the rich and poor by imposing tariff, then it will government policy will fail to do that, because indirect tax is an indirect tax. Indirect tax is a regressive tax, and its more impact is on the consumers, poor consumers, and less impact on the rich consumers. So as a result, poor will get poorer and rich will get richer. As a result, Gini coefficient will further increase and government will fail to achieve this objective of reducing disparities or income gap between the rich and poor. What would shift the marginal revenue product curve for labor producing electric vehicles to the right? Right, so marginal revenue product of labor is another name of demand for labor. So why demand for labor? Examiner is indirectly asking why demand for labor will shift to the right, right? DL to DL1, or DL is basically marginal revenue product, and this will be marginal revenue product 1. So why it may shift to the right? So you have to find out the reason for a rightward shift in marginal revenue product or demand for labor. Again, read all the options, and I'm explaining only one option that is correct, and this is option C for this question. Increase in price of electric vehicles. And if there is increase in price of electric vehicles, then what will happen is marginal revenue product of labor will increase. Marginal revenue product of labor is calculated as marginal physical product of labor multiplied by price, right? So marginal revenue product depends upon these two things: marginal physical product of labor and price. If price goes up, even if marginal physical product remains the same, marginal revenue product will increase, and when marginal revenue product increases, it will shift to the right. Again, read other options and get back to me if you feel any inconvenience in understanding other options. So question number 15 is the diagram shows perfectly comparative mark from average product and marginal product of labor curves. So this is average product, this is marginal product of labor. How many workers will the firm employ at wage rate W? If wage rate is W, then firm will employ this much amount of labor. So ON3, option C is the correct answer. This is the basic criteria that in perfectly comparative market, marginal revenue product, where marginal revenue product is equal to wages or marginal cost of labor, that is the equilibrium point. So this is the basic criteria or equilibrium condition, and the marginal revenue product should have declining trend, because marginal revenue product is also equal to wages at this point as well, but we can't choose this. marginal when falling part of marginal revenue curve is equal to marginal cost of labor or wages, then it forms an equilibrium. Okay, so moving to question number 16, and which change is likely to result in a decrease in the demand for money? Demand for money is like holding money in the form of liquid cash. So why people will decrease holding money in the form of liquid cash? So this is the question. And option B is the correct answer, a switch from monthly to weekly payment of wages, right? So this will decrease the demand for holding money, or like requirement of holding money in the form of liquid cash, because when people are getting income more frequently, like weekly instead of monthly, then it means they need not to hold more cash, because they expect to receive cash again every week, right? So they are frequently earning money, so they need not to hold money in larger amounts, so they will decrease the demand for money. Demand for money is holding money in the form of liquid cash, so they will hold less money if they are getting like wages more frequently. Okay, so if any other option confuses, please write in the comment. Question number 17 is, which combination of factors is most likely to lead to a decrease in structural unemployment? Structural unemployment is the type of unemployment that may be like caused by the technology, by the changes in law and order, government rules and regulations, like government may relocate the industry as well. So which factor is most likely to lead to reduction in structural unemployment, right? So option C is the correct answer for this question, and an increase in tariff and lower taxes for new businesses, right? If we do that, then structural unemployment will decrease, right? Reduction in import tariff will lead to like more investments taking place, because like importing raw material from other countries will also be cheaper now. And lower taxes for the new businesses. If new businesses are set up, then definitely what will happen is, okay, more jobs are created in the industry, and as a result more employment will take place and structural unemployment will decrease. In this question, the most confusing option is like B, that is basically subsidy to the technological improvement. Since the question is asking why structural unemployment will decrease, so if government provides subsidy to the industry for technological advancement, then structural unemployment will further rise, because now people will purchase more machinery, technology and tools, and they will hire lesser number of workers. So structural unemployment will further rise. So B cannot be the correct answer. Question number 18 says, why might country X have a higher natural rate of unemployment than country Y, right? So there is a large level of trade unionization in the country, in country X, right? Like higher level of trade unions are the association of workers, and association of workers basically try to create more unemployment, and they want to get higher wages for their workers. So as a result, natural unemployment level will increase if there are more unions working in the industry. And all other options are incorrect, because they will not increase rate of natural unemployment. Question number 19 is, over the period of a year, nominal national income increased by 2%. Nominal income is basically the income received in monetary terms, so that is 2%. Inflation rate was 3%, so we will deduct 3% inflation rate from here. And population increased by 1%, we will again deduct more 1% to find the final value. So 2% minus 3% minus 1% will give us 2% minus 3% is minus 1%, minus 1% is equal to minus 2%. So it means real GDP is decreasing 2% per head. So real income decreases 2%, per head. So we have like accommodated inflation, we have accommodated population as well. When we accommodate population, it becomes per head, and when we accommodate inflation, it becomes real income. Real income is income after the removal of distorting effect of inflation. So answer A is the correct option. Question number 20 says, what is likely to be the most effective policy to reduce inflation caused by the rapid rise in import prices? Right, so when import price increases, what happens is imported raw material will be now expensive, and it will lead to higher cost of production and high cost push inflation. And now we want to like reduce that inflation. What can we do that then? So for this question, a decrease in the domestic rate of interest, if we decrease interest rate domestically, it will lead to further decrease in value of currency, and imported raw material will get further expensive. So we cannot choose this option. It will further increase cost push inflation. A decrease in rate of income tax, if income tax decreases, then investors may be more comfortable getting imported raw material, and it may further increase demand cost push inflation. An increase in tariffs on imports, if government imposes tariffs on imports, then what will happen? Imports will further get expensive, and as a result, more people will have to pay more for imported raw material, and cost of production will further rise, and it will also cause cost push as well as demand pull inflation. So inflation will further rise instead of decreasing. So the remaining option is option C, that is the correct answer. Revaluation of exchange rate. Revaluation of exchange rate is increasing the value of currency against other currencies, and when it happens, price of exports will fall, and price of exports will rise, and price of imports will fall. And when price of import falls, imported raw material will get cheaper, and as a result, cost of production will fall, and when cost of production falls, it will lead to controlling cost push inflation. Okay, question number 21 is, which macroeconomic policy objective will not apply to a government in closed economy? Closed economies are the type of economies that are not involved in international trade. So the answer is really clear cut. So option C is the correct answer for this question. Achieving surplus balance of payment, right? So this is not the objective, because closed economy is the economy that is not involved in international trade, so there is no question for balance of payment deficit or surplus. So this is not the objective in closed economy. And question number 22 says, a government increases its budget deficit. Budget deficit is when government expenditure are greater than government revenue. So expenditures are greater than revenue, so it increases aggregate demand in the country. Okay, so to spend money on infrastructure development, it finances this by printing money. Okay, so how is this policy likely to affect government main macroeconomic policy objectives? Higher economic growth. Okay, so if aggregate demand is increasing, increase in aggregate demand can cause economic growth in the country. So economic growth is more likely, so we can cross these two options. And what happens to lower unemployment when aggregate demand is increasing? And it will lead to creating more job opportunities. So more likely. So unemployment may be lower because of this like economic action of the government. And lower inflation is less likely, because option C will be the correct answer then, because when aggregate demand increases, it will increase inflation instead of lowering it. So option C is the correct answer. Moving to question number 23, the government introduces interest rate in order to increases interest rate in order to reduce the rate of inflation. For better understanding, I suggest to like stop the video, read the question carefully, and read all the answers, all the options, then listen to the logic so that you understand it perfectly. Again, I'm explaining only one option, that is correct option, and in some cases I explain all of them where I think it is necessary and where questions are really clear cut, so I'm not explaining all of the answers. And again, the purpose is to save time. And question number 23 says the government increases interest rate in order to reduce rate of inflation, right? What will also result from this action, right? So for 23, option C is correct answer, reduction in economic growth, right? So when interest rate is high, people will save more money and invest less, so as a result aggregate demand in the country will fall. When aggregate demand falls, economic growth will also decrease. So we can like plot the values, real GDP here, and we can write price level here, and this is aggregate demand and this is aggregate supply. Equilibrium price level is P and real GDP is Y. So when interest rate is high, then what will happen? People will save more money and they will demand less, so aggregate demand will fall and aggregate demand will shift to the left. So equilibrium will move here, where real GDP will decrease to Y1 and price level will decrease to P1. So when real GDP falls, it decreases economic growth. So reduction in economic growth is the outcome of this policy. Okay, so question number 24 is regarding Laffer curve. Laffer said that when we increase tax rate initially, it will increase tax revenue, and after a certain point increase in tax rate will decrease tax revenue. So now we can read the question. The diagram shows relationship between income tax rate and tax revenue. So this is tax revenue, this is tax rate. Which statement is correct? Okay, so again I'll explain all of these options because I think they are confusing a little bit, so that you understand them perfectly. So option C, I'm explaining option C, that is the correct answer first, then I'll move to the other options. The greater rate of tax beyond Z, the smaller will be the tax revenue generated, right? So if tax rate increases from Z, then tax revenue will fall. This is the statement of question. So at tax rate Z, tax revenue is this much, and if we increase tax rate, let's say to this point, then tax revenue is decreasing. You can see that it has decreased. If we increase tax rate further, then tax revenue will further fall. If we increase tax rate further, tax revenue will further decrease. So increase in tax rate beyond Z is reducing tax revenue. So this is the correct answer. I believe you can understand other options easily if you understood what I explained for option C, that is correct answer. However, I'm explaining one more option as well. For example, it says that option A says correct answer is C, but I'm explaining A as well. A tax rate cut from Y to Z will cause tax revenue to decrease. So this is incorrect answer, because if tax rate is Y, then tax revenue is this much, right? If we cut tax rate from Y to Z, then you can see tax revenue has increased. So this is incorrect, because it is saying that decrease in tax rate decreases tax revenue, rather however tax revenue is increasing in this case. So this is not correct answer. You can evaluate other options as well. Question number 25 says, in which situation is devaluation of currency most likely to cause inflation? Devaluation of currency is when you decrease the value of currency deliberately through central bank in fixed exchange rate system, and when currency is devaluated, it decreases price of exports, it increases price of imports. So imports get expensive, export get cheaper. So how is it likely to cause inflation? Inflation is the rise in general prices over time. Again, option C is the correct answer for this question as well. The local substitutes of imported raw materials are unavailable, right? So government has devaluated the currency to make imports expensive so that less people can import imported goods. But if raw material imported, there are no substitutes available for imported raw material within the country, then people will be forced to import like raw material from other countries even if it is expensive. So this will this is most likely to cause inflation, that is cost push inflation, because increase in imported price of imported raw material will increase cost of production and cause cost push inflation. Question number 26 says a country imports most of the raw material used as factor imports. Which policy is most likely to control cost push inflation? Right, cost push inflation is the kind of inflation which is caused by increase in cost of production. And which policy is most likely? It means all of options can be correct, but one option is most likely that will control cost push inflation. Okay, so option A is appreciation of exchange rate of currency. If currency appreciates, then price of exports will rise, price of imports will fall. When imports are cheaper, then imported raw material will be cheaper, and as a result cost of imported raw material will decrease. When cost of production decreases, cost push inflation is controlled. So option A is the correct answer. So I'm not explaining other options. If you are confused, you can write in the chat and I'll get back to you. Question number 27 says Germany, one of the world's largest trading nations, achieved a surplus on current account of balance of payment in 2021 and 22. 2021 to 22. Which income flow would not, focus on this word, not have been included in calculation of Germany's current account? Right, so declining in sales of German cars exports, this is the part of current account, so it will be included. So we have to find out the figure that is not included. So option A is incorrect. Moving to the second part, falling earnings, foreign exchange from the visitors. So this is invisible export, so it is again the part of export, so it is included in current account. Next is increasing transfer aids, transfer payments and aids are the part of secondary incomes, and they are included in current account. So the right option, the left one, is the option D, and option D says investment in natural gas pipeline linked to its main foreign suppliers. So investments are the part of capital instead of current account of balance of payment. So there are three accounts mainly: current account of balance of payment, capital account and financial account. So investment is not the part of current account, it is a part of financial account rather, not capital account, please. So option D is the correct answer. Question number 28 is a country maintains its foreign exchange rate against the United States dollar within a narrow range, a narrow but changing band. What is this type of exchange rate? This is type of managed floating exchange rate because it can float. Float means change. It can change but within the prescribed limits. When exchange rate can change within the prescribed limit, that is called managed float. Right, so fixed exchange rate is the exchange rate that does not change. Floating exchange rate is the exchange rate that changes depending upon the demand and supply, changes in the demand and supply of the currency. And managed float is managed by the central bank of the country, and it can float or change within the prescribed limits. So this is also incorrect. Trade weighted exchange rate is not basically the kind of exchange rate system. So exchange rate systems are fixed, floating and managed floating. Okay, so now moving to question number 29, the Lorentz curves. Lorentz curves in this diagram show different distributions of income and wealth. Right, so at first, income in a country is more equally distributed than wealth. So out of these four Lorentz curves, curve 1 and 2 will be the income, difference of income, Lorentz curve for percentage income, and curve 3 and 4 will be for wealth, because examiner is saying that income in a country is more equally distributed, so they should be near to the 45-degree line. 45-degree line shows that income is perfectly distributed among all the individuals and all the residents of a country. Right, if we go away from 45-degree line, it shows disparities. Right, and disparities are initially lower in case of income and more in case of wealth. So these 3 and 4 are for wealth and 1 and 2 are for income. Next, the examiner says in a period the distribution of income becomes more unequal, right? If it is income is getting more unequal, it means we will go away from 45-degree line. So let me change the color. So closer one was this, and we are getting away from 45-degree line when we move to from 1 to 2. So for income, it should be movement from 1 to 2. So income distribution shift from curve 1 to curve 2. So there is no other option that shows movement from 1 to 2. So we need not to like consult other options because we have already shortlisted it. And what should happen to the distribution of wealth? It says that but distribution of wealth becomes more equal, right? So more equal mean we will move towards the 45-degree line. So movement from 4 to 3 is getting closer to the 45-degree line. So 4 to 3 will be more equal distribution of income, equal distribution of wealth. So option A is the correct answer. And the last question is, what is likely to happen if a developing country as it becomes more developed, right? What is likely to happen in a developing country if it becomes more developed, right? So it was poor nation, now it becomes rich nation. So what will happen? A lower percentage of people will go to university. This is incorrect because in developed nations people afford to go to the university. And option B is average life expectancy will rise. So this is the correct answer because in developed countries there are better facilities, medical facilities, better living standards. So as a result, life expectancy increases. And option B is the correct answer. However, I'm explaining others as well. The rate of population growth will increase. So it is incorrect because rate of population growth is controlled when country becomes developed, right? So because of better facilities, health facilities. The tertiary sector will decline in importance. This is also incorrect because when country becomes developed country, tertiary sector increases in importance. So option A is the correct answer. So this is it for this video, and in tomorrow's video I'll explain you some important questions that may be tested in June 2024 exam series for paper 3 day after tomorrow. And wish you best of luck. See you inshallah soon. Allah Hafiz.